We are looking at a paradox today that has just always blown my mind. Why do 99% of startups completely fail, yet the venture capitalists, the VCs who invest in them, somehow make billions of dollars?
Yeah,
You look at those numbers and it just seems like the game is rigged or it's based on some secret business magic. But the answer isn't magic. It is pure, unforgiving mathematics.
it really is. The foundational architecture of that world isn't about picking winners in the way most people think.
Right.
So we're exploring the mathematical and statistical structures that govern risk, reward, and the distribution of wealth. Specifically, we're going to contrast power law distributions with normal and log normal distributions.
And to do this, we've got an incredibly dense, highly technical Q&A transcript in front of us today. We're talking heavy-duty econometrics, deep statistics, and, the underlying mechanical gears of venture
It's
capital.
a lot of math.
It is a lot. But our mission for this deep dive is to demystify these complex formulas and translate them into a fundamental understanding of how the real world operates. We're going to connect these abstract concepts to startup funding, to your annual salary, and to the stock market.
Mhm.
Okay, let's unpack this. We have to start with the most extreme real-world application from our sources, which is venture capital.
Right.
Why does VC absolutely refuse to follow a standard, comforting bill curve?
Well, what's fascinating here is that VC is fundamentally built on an asymmetric payoff structure. It operates almost exactly like a multi-year, high-stakes, long call option in finance.
Okay.
Now, in standard finance, or even in our daily lives, like when you buy a house or put money in a savings account, we usually expect risk and reward to be somewhat symmetrical.
You risk a little, you gain a little.
Exactly. You risk a lot, you might lose a lot. But venture capital has this built-in convexity.
Let's pause on that word,
Yeah.
convexity. What does that actually look like in practice?
It means the downside and the upside operate on entirely different mathematical planes. The downside is strictly bounded. It is capped.
Okay.
The absolute worst a VC can do on a single investment is lose 100% of the money they put in.
Right.
Mathematically, that's a negative 1x return. If a startup burns through $10 million and goes spectacularly bankrupt, the venture capitalist doesn't suddenly owe the bank another $20 million.
Right.
The loss stops at the floor. The downside is legally and mathematically walled off.
Which is very different from, say, shorting a stock, where your losses can theoretically go to infinity if the stock price keeps climbing.
Exactly.
Here, the floor is solid, but the ceiling, there is no ceiling.
None at all. The upside is completely unbounded. An investment could return 10 times your money, 100 times, or even 1,000 times. There is no mathematical limit to how large a company can grow or how valuable its equity can become.
So, if I'm trying to visualize this, it's kind of like a bizarre asymmetrical lottery. Imagine a lottery where a losing ticket costs you $10. But if you buy the winning ticket, you don't just win a $1 million jackpot. You actually win ownership of the entire lottery company.
That's a great way to look at it.
One positive 100x win mathematically erases 99 total wipeouts. The structure makes the frequency of losses completely irrelevant, as long as the magnitude of that one win is large enough.
And that natural convexity completely shatters the foundation of symmetrical normal distributions. Normal distribution, the classic bell curves we all learn about in high school statistics,
Right.
those usually emerge from the addition of many independent random variables.
Like human height, right.
Precisely. Lots of independent genetic markers and environmental factors like childhood nutrition. They all add up. Some pull you taller, some pull you shorter, and they inevitably anchor the vast majority of people toward the middle.
The average.
The average, exactly. But power laws, which govern these massive startup returns, they do not come from independent addition. They come from multiplicative growth and preferential attachment.
The sources mention Jabrat's law of proportionate effect here, and this idea of a multiplicative cascade. Let's dig into that because I don't want to just, throw terms around.
Sure.
How does Jabrat's law actually build a power law?
Think of it this way. Jabrat's law suggests that the growth rate of a company is independent of its absolute size. If a company has a fundamental 10% chance of doubling in size every year, That probability applies whether the company's worth $1 million or $1 billion.
Oh, I see. So it's not adding $10 a year, it's multiplying by a factor.
Yes. So instead of independent variables adding a fixed amount,
Yeah.
you have self-correlating variables that multiply. It's an exponential compounding effect.
Wow.
And when you combine that multiplicative growth with what sociologists call the Matthew effect, which is mathematically described in our sources as a Yule-Simon process, you get this extreme skew.
The Matthew effect, the whole, to those who have, more will be given. The rich get richer.
Correct. Let's make that tangible for startups.
Mm.
Early advantages compound aggressively. A startup that secures a tiny early advantage in talent or maybe gets a small seed round from a well-known investor,
Right.
they use that slight edge to attract disproportionately more media attention.
And that media attention makes it easier to recruit better engineers.
Exactly, which allows them to build a better product faster, which attracts a massive Series A funding round. The change in their valuation today is directly proportional to their valuation yesterday. It's a continuous positive feedback loop.
And this loop is basically strapped to a rocket engine by modern technology. The sources talk extensively about zero marginal cost and network effects.
Yes.
Like, if I'm building a traditional business, like a chain of coffee shops, every new customer requires me to buy more coffee beans, hire more baristas, eventually run a new building.
There's friction.
Right, the physical world creates friction that slows down that multiplicative growth.
Yeah.
But if I build a software product or train a new AI model, my fixed research and development costs might be astronomical upfront,
Sure.
but the cost to distribute that software to the very next user is effectively zero.
And if we connect this to the bigger picture, that zero marginal cost fundamentally alters the competitive landscape. Once a technological moat or a network effect is established, think about a social media platform where the value is entirely based on the fact that all your friends are already on it.
Right, you can't just move to a new one.
Exactly. The market naturally defaults to a winner-take-all dynamic. The top one or two companies don't just command a slight premium over their competitors, they hoard 80 to 90% of the entire market share.
So let's look at how this plays out inside a VC's portfolio. The text gives us this incredible mathematical breakdown called the Babe Ruth effect. For anyone who doesn't know baseball, Babe Ruth was famous for hitting massive home runs, but he also struck out constantly. The underlying philosophy is that the magnitude of the hits matters more than the frequency of the misses. Let's walk through the math. Imagine a venture capital fund, we'll call it Fund F, and they invest in 30 different early-stage projects.
Which is a very standard portfolio size for a traditional venture fund. They spread their bets.
Okay, so the lifespan of the fund plays out. 25 of those 30 projects either completely fail and go to zero, or they just stagnate as zombie companies.
Yep.
Returning less capital than was originally put into them. They are essentially write-offs. That's over 80% of the portfolio failing.
It's brutal.
Then you have 4 projects that do okay. They manage to exit or go public and return about 3 times the initial investment. A solid triple.
Now, in a normal world, or in traditional private equity, a 3x return would be celebrated as a phenomenal outcome.
But in VC, it barely moves the needle.
Right.
Because then you have one outlier. Just one company out of 30. And it returns 100 times the initial investment. Because of the math, that single investment, which is representing just over 3% of the total bets, returns roughly 3.3 times the size of the entire fund.
This is the defining feature of a power law system. I want to highlight the sheer scale of that imbalance. The extreme value, that single 100x outlier, completely dwarfs the sum of all the normal and failed samples combined.
Yeah.
That single win didn't just contribute to the fund's success, it independently dictated the entire return profile. If they had missed that one specific startup, the entire fund would be considered a failure.
And what actually shocked me reading this is the double power law.
Oh, yeah.
We tend to focus on the startups themselves falling into this extreme distribution, but the VC firms follow a power law too. It's not a level playing field for the investors.
The preferential attachment happens on both sides of the table. Top-tier founders, the ones who are actually capable of building those potential 100x companies, they actively flock to top-tier VC brands. Firms like Sequoia, Andreessen Horowitz, or Benchmark.
Because they want the best advice.
Well, advice is part of it, but it's mostly about signaling. The brand endorsement of a top-tier VC drastically lowers the friction for future fundraising, hiring, and customer acquisition.
Ah, I see.
If Sequoia backs you, the market assumes you are a winner. This dynamic creates a monopoly on top deal flow for the best firms. The best founders go to the best funds, which generates the highest returns, which attracts the most institutional capital, which allows them to back the next generation of best founders.
Wow.
The result of this double power law is that the top 2% of VC firms capture over 90% of the entire venture capital industry's profits. The rest are basically just churning capital.
Okay, so since venture capital, and frankly our entire modern tech economy, rely entirely on these massive outliers, we need to fundamentally redefine how we look at statistics and tail risk.
We do.
We are deeply conditioned, almost brainwashed, to think in terms of bell curves. Why is a power law so mathematically alien compared to a normal distribution? Let's talk about the speed of tail decay.
This concept is the crux of why traditional financial models fail to predict modern economic reality. In statistics, the tail refers to the extreme edges of a distribution, the highly unlikely events.
Right.
In a normal distribution, the probability of extreme events decays exponentially. If you look at the formula for a Gaussian curve, it uses the exponential constant e to the power of -x squared.
That x squared is doing a lot of heavy lifting.
It is doing all the heavy lifting. That squaring mechanism means that as you move further away from the average, as x gets larger, the probability of that event occurring drops off a cliff. It's an ultra-fast exponential decay.
Wow.
The curve rushes towards zero so quickly that extreme events become statistically impossible.
But in a power law distribution, the text points out that the tail decays polynomially, not exponentially. The formula is x to the power of -alpha minus 1.
Right.
Because it's polynomial, meaning it's just x to a constant power rather than e to the power of x, the drop-off isn't a cliff. It's
Yeah.
a slow, gentle, lingering slope. It's what statisticians call a fat tail or a heavy tail.
Exactly.
And the sources point out an amazing mathematical truth. In the calculus limit, as you move further out toward infinity, the probability of an event in a normal distribution relative to a power law distribution is effectively zero. The normal distribution simply gives up, while the power law keeps producing outliers.
To make those abstract shapes real, the source text compares 3 sigma and 6 sigma events. Sigma simply means standard deviations from the mean.
Okay.
In a normal distribution, a 3 sigma event, something noticeably rare, happens about 0.13% of the time. That translates to roughly 1 in every 770 occurrences. So unlikely, but you'll see it. But a 6 sigma event, moving twice as far out.
In a normal distribution, a 6 sigma event is about 1 in a billion. If human height were perfectly normal, a 6 sigma event would be someone who's like 11 feet tall. It is practically impossible in our daily lives.
Exactly. But in a power law distribution, jumping from a 10x extreme event to a 100x extreme event doesn't cause the probability to drop by a factor of a billion. It only drops by 1 or 2 orders of magnitude.
That's a huge difference.
It is. Extreme events aren't impossible anomalies in this world. They're a structurally guaranteed feature of the system.
And the sources point out that taking the safe, comfortable math of a normal distribution and blindly applying it to a power law world has catastrophic consequences. The expert Q&A breaks this down into 3 specific systemic corollaries, 3 fatal flaws of using normal math where it doesn't belong. Let's walk through them because this really clarifies the danger.
The first fatal flaw is black swan dominance. In a normal distribution, the mean, the average, is driven by the vast middle majority. If you take the average height of the 1,000 people, it is highly representative of the group. But in a power law environment, the overall mean is dictated almost entirely by the extreme outliers at the far end of the tail. The middle majority is statistically irrelevant to the total sum.
Which leads right into the second flaw, which is sample variance fails. Now, in normal statistics, there's this comforting rule called the central limit theorem. It basically says that as you collect more data, your variance settles down. Your average gets more stable and accurate. If I measure 10 people, my average height might be a little off. If I measure 10,000 people, my average is going to be rock solid.
But not in a power law environment. When you apply the central limit theorem to a fat-tailed distribution, it completely collapses.
Why is that?
As you collect more data, the variance doesn't settle down, it actually keeps jumping higher. Because the more data you collect, the higher the probability that you will eventually hit a new, even more extreme outlier that completely blows up your previous calculations.
Oh, wow.
You never reach a stable average because the next observation could always be a massive magnitude larger than anything you've seen before.
Which perfectly sets up the third flaw, and I have to say this is my absolute favorite analogy from the source text to explain why the mean is essentially a lie in these environments. The host of the Q&A, brings up the Bill Gates in a dive bar analogy.
It's a classic for a reason.
Let's just visualize it. You are sitting in a standard neighborhood dive bar with 50 people. You go around and calculate the average wealth of the people in that room. Let's say it comes out to $60,000.
Okay.
That average is highly predictive. It tells you a lot about the economic reality of a random person sitting on a bar stool in that room. The variance is bounded. But then Bill Gates walks into the bar.
Bringing a net worth of, say, $130 billion.
Right. Suddenly, the average wealth of everyone inside that bar jumps to roughly $2.5 billion per person.
Right.
But here is the critical insight. That new average tells you absolutely nothing about the actual people sitting on those bar stools.
Right. Nobody's life changed.
Nobody in that bar got richer. The mean has lost all predictive meaning. If you try to build an economic model based on that $2.5 billion average, your model will fail spectacularly because it doesn't reflect the lived reality of 50 out of the 51 people in the room.
This raises a profoundly important question for traditional finance and economics. Modern portfolio theory, or MPT, is the absolute bedrock of standard investing. It is what most pension funds and retirement accounts are built on.
Yeah.
MPT relies entirely on calculating predictable means and bounded variances to optimize a portfolio, balancing risk against expected return. But when MPT is applied to venture capital, or to wealth distribution, or even to internet traffic bandwidth, where the underlying math is a power law with an exponent less than or equal to 2,
It just breaks.
it completely breaks down. The math literally cannot handle the fat tails. It assumes the dive bar average is real.
Okay, let's look under the hood of these fat tails. What is the actual mathematical shape we are talking about? The sources use the terms power law and Pareto distribution quite a bit, almost interchangeably at times. Are they actually the exact same thing?
Not exactly, and the distinction is important for clarity. Power law is the broad, overarching family of mathematical distributions, where the frequency of an item is inversely proportional to a power of its size.
Okay.
The Pareto distribution is a specific, classic, continuous realization of a power law. It was originally formulated by the Italian civil engineer and economist Vilfredo Pareto in the late 19th century to describe how wealth was distributed in society.
The classic 80-20 rule. 80% of the land in Italy was owned by 20% of the population.
Exactly. The Pareto distribution models continuous variables like wealth or income, where you can have fractional allowance. But there are also discrete power laws, which deal with whole numbers. For example, Zipf's law governs how often words are used in human language. The most common word in English, the, is used twice as often as the second most common word, and 3 times as often as the third.
Interesting.
Or the Yule-Simon distribution, which we mentioned earlier, which models the number of connections in a network node. The rule of thumb here is simple. All Pareto distributions are power laws, but not all power laws are Paretos.
Let's get into the formula itself. It is relatively simple on the surface. The probability of x is proportional to x to the power of negative alpha. But the sources highlight 2 crazy properties that emerge from this simple equation. The first is that it is scale-free.
Scale-free is a fascinating concept. It means there is no typical scale or characteristic average that defines the system. Whether you zoom in on a microscopic part of the data, say looking at the distribution of wealth among millionaires,
Right?
or zoom out to the macro level to look at the entire global economy, the relative probabilities look identical. It behaves like a fractal. A piece of the curve looks exactly like the whole curve.
That makes sense. And the second property is log-log linearity, which is crucial for actually visualizing this stuff.
Yeah.
If you plot a power law on a standard chart, you just get this massive L shape. All the data is crammed into the left corner, and a long invisible tail stretches to the right. It's unreadable.
Like the sheer scale of the outliers ruins the visual.
But if you plot that exact same data on a chart where both the x and y axes are logarithmic, meaning the intervals go up by multiples of 10 instead of 1, so it goes 1, 10, 100, 1,000,
Yeah.
that gentle, curving L shape magically straightens out into a perfectly straight line with a downward slope, and the slope of that line is exactly negative alpha.
That visual transformation isn't just a neat trick. It is the primary diagnostic tool for statisticians.
Yeah.
If you have a messy set of real-world data and you want to know if it's a power law, you plot it on a log-log chart. If it forms a straight line, you know you are dealing with fat tails and extreme outliers.
Okay, here is where I have to push back on the math for a second, because this bothered me while I was reading. The formula has an exponent of negative alpha. Why does the exponent have to be negative? I mean, mathematically, what happens if we use a positive power? Why can't alpha be a negative number, which would make the whole exponent a positive integer?
That is a fantastic foundational question, and it gets right to the heart of what a probability distribution actually is. It all comes down to the integral constraint.
The integral constraint. I haven't taken calculus in a while. Walk me through it.
Think about the fundamental rule of probability. For any model to be mathematically valid, if you add up the probabilities of every single possible event occurring, from the absolute smallest outcome all the way out to infinity, it must equal exactly 1.
100%.
100%. You cannot have a probability greater than 100% that something will happen. In calculus, we find this total sum by taking the integral, which calculates the total area under the curve.
Okay, I'm following. The area under the curve has to equal 1.
Now, imagine if the exponent were positive. Let's say x to the power of positive 2. As x gets bigger and bigger, moving to the right on the graph, the value of the function would get bigger and bigger. The curve would slope upwards.
Right.
If you try to calculate the area under an upward sloping curve out to infinity, it doesn't sum to 1. The area diverges out to infinity. The math literally explodes.
Oh, wow.
Therefore, to ensure that the tail eventually tapers off, even if it tapers very, very slowly, so that the total area underneath it converges to exactly 1, the parameter alpha must be strictly greater than 0. That gives us the negative exponent. The curve has to slope downward.
Ah, I see. So it's a structural requirement. If it doesn't slope down, it's not a probability. It's just a line going to infinity.
Yeah.
That makes perfect sense.
Okay.
So we've mapped single variables. We know how wealth is distributed or how startup returns are distributed in isolation. But economics isn't just about single variables sitting in a vacuum. It's about cause and effect. It's about how one thing affects another. How does price affect demand? How does a change in interest rates affect housing? How does the power law translate into the relationship between two different variables?
This is where we transition from single probability density functions, which just describe the shape of one thing, to bivariate regression, which models the relationship between two things. And the concept that connects them in the source text is called structural isomorphism.
Here's where it gets really interesting. Structural isomorphism. It sounds incredibly intimidating, like something from a physics textbook, but the sources break it down beautifully.
It's actually a very elegant idea. Structural isomorphism simply means that a single variable power law probability distribution and a two-variable power law regression share the exact same mathematical skeleton, log-log linearity.
So if you plot them both on that logarithmic chart, they both form straight lines.
Exactly. They look identical in their geometry. The formula for the regression is y equals beta 0 times x to the power of beta 1 multiplied by an error term, epsilon.
But the sources aggressively stress that even though they look the same mathematically, they have totally different statistical souls. A researcher cannot treat them as the same thing.
Precisely. A probability density function, as we just discussed with the integral constraint, has to sum to exactly 1. It is bound by the laws of probability. But in a regression, which is just an equation measuring how x impacts y,
Right.
that exponent, beta 1, can be absolutely any real number. It can be positive, it can be negative, it can be a tiny fraction.
Yeah.
It doesn't have to sum to anything because it's measuring a relationship, not a total probability.
Makes sense.
Furthermore, in a single variable distribution, the randomness is baked into the variable itself. In a regression model, the relationship between x and y is a deterministic mapping, and the randomness is isolated entirely in the error term, that epsilon on the end of the equation.
And translating that regression equation into plain English brings us to one of the most powerful and practical concepts in all of economics, which is elasticity. If you've ever taken an Econ 101 class, you've heard this word. In that constant elasticity model we just mentioned, y equals a times x to the power of beta. The exponent beta is the elasticity.
It is the holy grail of pricing models for businesses everywhere.
Right. Because elasticity is just a fancy way of saying a 1% change in x causes an average beta percent change in y. It's a ratio of percentages. The sources give some classic examples of this in action. Price elasticity of demand is the most famous.
Right.
If a company raises the price of its product by 1%, what percentage does consumer demand drop? If beta is -2, a 1% price hike causes a 2% drop in sales. Another massive one is the Cobb-Douglas production function, which looks at how a 1% increase in capital or labor changes the total economic output of a factory or a country.
And we can prove why this works mathematically through the source text. There's a very important distinction to make here between global exactness and local approximation.
Let's break that down, because earlier we talked about power laws being scale-free, meaning they work the same at any magnitude. How does that relate to a 1% change?
So because of the scale-free nature of the power law function, we have exact scale invariance globally. What that means is, if your input x grows by exactly 10 times, a massive jump, your output y will grow by exactly 10 to the power of beta times. That mathematical relationship holds perfectly true whether x is starting at 1, a million, or a billion. It is globally exact.
But when a business manager is talking about elasticity in a boardroom, they don't talk about scaling the company by 10 times overnight. They say, what happens if we tweak the price by a 1% change?
Yes, and that 1% to beta percent rule is technically an approximation, specifically as a first-order Taylor expansion. It's a local tangent line approximation using calculus.
Okay, translate that for me.
Imagine you were walking along the curved line of a graph. If you look far ahead, the line curves away from you. But if you only look 1 inch in front of your feet, the curve looks perfectly straight.
Right, like the horizon.
Exactly. A Taylor expansion calculates the slope of that perfectly straight inch. For tiny incremental changes like 1%, the straight line approximation is near perfect compared to the actual curved math.
Wow.
The text proves this beautifully. If your elasticity beta is 2, and you increase x by 1%, the quick approximation says y increases by 2%. The actual exact math requires squaring 1.01, and 1.01 squared is 1.0201.
Ah! So the quick approximation tells you 2%, and the deep math tells you 2.01%. The approximation is incredibly accurate, just missing a microscopic squared error term of 0.01%.
Exactly. For all practical intents and purposes, the math holds up beautifully for local, marginal decisions that businesses make every day.
So we've spent all this time so far in the extremes. We've looked at the winner-takes-all dynamics, the bounded downside of venture capital, the fat tails, the billionaires ruining the dive bar average.
The fun stuff.
But what about the rest of the world? Because not everything is a startup, and not everyone is Bill Gates. What about the things that do tend to cluster in the middle, but still aren't a perfect symmetrical bell curve? Like human salaries, there is a vast middle class, but there are also extreme billionaires. It's clearly not a normal bell curve, but it's also not a pure winner-take-all power law either. This brings us to a massive pivot in our sources, which is the log-normal paradigm shift.
This is an incredibly important bridge between the two extremes we've discussed.
Yeah.
A log-normal distribution is quite literal in its mathematical definition. If a variable x is log-normal, it means that taking its natural logarithm results in a standard, perfectly symmetrical normal distribution. And conversely, if you start with a normally distributed variable y, taking e to the power of y gives you a log-normal distribution.
Okay, let's visualize this. If we go back to our double logarithmic chart, the one where the power law was a perfectly straight line slanting downwards, what does a log-normal distribution look like on that same chart?
Well, it isn't a straight line anymore. On a log-log plot, a log-normal distribution forms a downward opening parabola. It looks like an upside-down U. It has what the text calls a sub-exponential tail.
Sub-exponential, meaning it's somewhere in between the two.
Exactly. It's thicker and heavier than a normal bell curve, meaning there are far more upper middle class and rich people than a bell curve would predict. But the tail is much thinner and decays faster than a pure power law, so it's not purely a winner-take-all system where one person has everything.
What I found absolutely fascinating here is the underlying generative mechanism. We spent a lot of time establishing that power laws are born from preferential attachment, the rich get richer, the network effects where nodes actively seek out the biggest hubs. But log-normal distributions have a profoundly different philosophical origin. They aren't driven by preferential advantage. They are generated by the accumulation of thousands of independent, multiplicative, random shocks.
This is a crucial distinction. Independent, not preferential. It is essentially the central limit theorem operating in logarithmic space.
Give me a real-world example of those independent multiplicative shocks, because that phrasing is a bit dense. How does that actually create a log-normal curve?
A classic example in finance is geometric Brownian motion, which is the foundational model for stock prices. Think about how a stock price moves day to day. Today's price is the result of thousands of independent percentage changes. The market might give the stock a 1% bump on Tuesday due to a good earnings report, and then a 0.5% drop on Wednesday because of a macro inflation worry. Because these are percentages applied to the previous day's total, they multiply rather than add. But Tuesday's bump didn't cause Wednesday's drop. They're independent shocks.
And another great example from the text is the income distribution of the vast middle class. Think about how your career salary evolves. Your current salary is a culmination of independent percentage bumps over decades. A 3% annual raise here, a cost of living inflation adjustment there, maybe a 15% bump when you change jobs,
Yep.
or a 10% bonus multiplier in a good year. All those independent percentage shocks multiply together to land you at your current salary.
And crucially, log normal variables are strictly non-negative. You can't have a negative stock price because it's bound by zero.
Wow.
And you can't have a negative salary. You can't owe your employer money for the privilege of working. The mathematical floor is absolute zero, which makes the log normal distribution perfect for modeling these real-world economic realities where values can only go up or down to zero, but not below.
But this naturally bounded, right-skewed shape introduces a very tricky mathematical quirk that the sources call the Jensen's inequality tax.
Oh yeah, this is a statistical trapdoor that catches a lot of junior analysts.
Okay, let's unpack this tax. If I'm listening to this and I'm planning my retirement or analyzing data for my job, how does this tax affect me?
Because a log normal distribution has a long tail dragging out to the right, representing those upper middle class and wealthy individuals, the shape is fundamentally asymmetrical. In a perfectly symmetrical normal bell curve, the mean, the median, and the mode are all exactly the same number sitting right at the peak in the middle.
Okay.
But in an asymmetrical log normal distribution, they separate. The long tail acts like a mathematical magnet, pulling the mean, which is the true expected average, upwards and to the right, away from the median.
Okay, so the average is higher than the median because the rich people pull it up. That makes sense. But how does that become a tax on a model?
Imagine an economist is trying to predict future salaries using a log normal regression model. They run their data, they predict the log of y, and then they simply exponentiate that result to get back to regular readable dollars. What number do they actually get?
According to the text, if you just exponentiate the log prediction, you only get the median. You get the mathematical middle of the pack, the 50th percentile.
Exactly. You do not get the true expected value, the mean. To find the actual mean, the economist must perform a convexity adjustment. They have to add a smearing estimate to their log formula before they exponentiate.
A smearing estimate.
Mathematically, they have to add the variance squared divided by 2. If you forget that convexity adjustment, if you forget the Jensen's inequality tax, your financial models will systematically and substantially underpredict the average outcome.
That is wild. If you are a financial planner or a policymaker and you ignore the variance squared divided by 2, you are literally erasing wealth from your projections. You are predicting a poorer future than the math dictates.
It happens all the time.
Which brings us to the final piece of the puzzle, which is semi-elasticity. We talked about elasticity being a percentage affecting a percentage. How do economists actually write down these log normal relationships to predict everyday things, like how much a master's degree will increase our paychecks?
For these relationships, they use what's called the semi-log model. The formula is slightly different from the power law regression. Here, the natural log of y equals beta 0 plus beta 1 times x. Notice the crucial difference. X is not logged here, only y is.
Right. So earlier, with pure elasticity, we were comparing a percentage change to a percentage change. A 1% drop in price equals a 2% drop in demand. What does semi-elasticity measure?
Semi-elasticity compares an absolute unit change in x to a relative percentage change in y. It bridges the gap between additive units and multiplicative growth. The rule of thumb translation is a 1-unit absolute increase in x results in a roughly 100 times beta 1% change in y.
Let's make that deeply concrete with the examples from the text, because this affects almost everyone listening. In labor economics, there is a famous formula called the Mincer earnings equation. It models the log of your wages, your salary, against your absolute years of education. So X is measured in years, 1, 2, 3 years. Y is measured in dollars.
Right. So according to the semi-elasticity model, every 1 absolute year of additional education you get, say taking 1 year to get a specialized certification, yields an X% relative increase in your salary. You are trading an absolute unit of time for a multiplicative percentage jump in wealth.
We see the exact same math applied in standard finance with the concept of modified duration in bonds. Bond markets rely on this. A 1% absolute change in market interest rates, which finance people call 100 basis points, causes an X% relative drop in the bond's overall price. Absolute change in the input equals a relative percentage change in the output.
Exactly. It's the mathematical cheat sheet for translating linear effort or linear time into exponential or logarithmic returns.
Okay, before we wrap up, there is a massive point of confusion that the sources specifically take time to call out, and we need to clarify it. It's the confusion between a function and a distribution. The host of the Q&A in the text mentions that people constantly mix these up.
Yes, this is an incredibly common statistical misconception, even among professionals. Just because you write down the semi-log regression equation, log of y equals beta 0 plus beta 1 times x, does not mean that y and x magically follow a log normal or power law probability distribution in the real world.
But people say that all the time. You hear data analysts say, oh, we ran the regression, so they have a log-normal relationship.
Right. In casual conversation, they use it as shorthand. But strictly speaking, mathematically, it is completely false. The regression equation just describes a geometric functional mapping between two variables. It is completely deterministic. If I plug in x, I get y. There's no probability involved in the core function.
Okay.
The equation only becomes a probability distribution when you do two very specific things. First, you have to add a specific Gaussian error term, that epsilon, to introduce uncertainty. And second, you have to explicitly define the underlying probability distribution of the independent variables themselves.
So the equation is just the engine block. It doesn't do anything on its own. The distribution is the fuel you pour into it to make it run and generate probabilities. If you pour in normal fuel, you get normal probabilities.
Precisely. You cannot assume the shape of the data just by looking at the shape of the equation.
So, what does this all mean? We have gone down a massive, deeply technical rabbit hole today. We started with the brutal, convex math of venture capital funds, where the entire ecosystem requires one single home run out of 30 at-bats just to survive, and where cap downsides and infinite upsides distort normal risk.
Yeah.
We saw how power laws and Pareto distributions dictate winner-take-all scenarios, driven by zero marginal costs and network effects that allow early advantages to compound infinitely. We explored the mathematical boundaries of fat tails, where Six Sigma events aren't impossible miracles but a regular Tuesday, and where Bill Gates walking into a dive bar completely ruins the concept of an average.
It sure does.
And finally, we mapped the subtle parabolic curves of log-normal salaries, driven by independent multiplicative shocks and semi-elasticity. It's a profound reminder that the deep math of distributions isn't just abstract theory living on a chalkboard in university. It is the invisible architecture of consequences in our daily lives.
It really is the underlying operating system of the modern economy. And looking at this source material, there is a final thought that we should leave everyone with, a bit of extrapolation based on everything we've unpacked today. We noted early on that power laws, those extreme winner-take-all dynamics, absolutely thrive in environments characterized by zero marginal cost and network effects. Software, digital platforms, artificial intelligence.
Right. Build the code once, and you can distribute it infinitely to billions of people for essentially free.
Now consider the broader trajectory of our modern digital economy. We are systematically digitizing the physical world. We're digitizing logistics, supply chains, and increasingly even human services like medical diagnostics, legal research, or creative writing through AI models. We're effectively reducing the marginal distribution costs of highly complex services to nearly zero across the board in industries that have historically been constrained by the physical limits of human time and geography.
Oh, wow. I see where you're going with this.
So here's the question to ponder. If this aggressive digitization continues to strip away the physical friction of the world, will the mathematical power law eventually consume domains that have traditionally followed safe, comfortable, log-normal distributions?
That's a scary thought.
Could the mathematical middle class of everything, from local service businesses to specialized human skills that currently enjoy a log-normal salary, eventually be erased by the unforgiving winner-take-all mechanics of the Pareto distribution? Are we mathematically engineering a future economy where the middle simply ceases to exist?
Something to seriously mull over the next time you hear someone talk about average returns or a safe middle-class career path. The math might be changing right beneath our feet.